CPA, but I had a lot of the medical community in the town I was living at the time, and I had a few engineers. And as I transitioned into the investment advising business through a CFP and did holistic financial planning, I made the commitment that I appreciate the work that doctors do, but I don't want them as clients. And I appreciate what engineers do, but I don't want them as clients either. Because in both cases, the egos got in the way of being able to have an open dialogue about advice and so forth. And there are exceptions, they're all individuals and so forth, but it was harder for me to get the doctors that were clients of mine to follow my advice. They were headstrong in what they believed, and it was a challenge. So it was just easier to go in a different direction. And you could ask your advisor those kinds of questions, and I'm sure they would tell you what they think, or hopefully they would. If they don't, it's probably another issue, I guess, to question. There's some advisor questions. I'll just call out a couple of these as potential considerations. You can take a look at them, evaluate. Have any of your designations or securities licenses been revoked or subject to complaints? There are now websites, obviously broker check, that you can go on to see if there are any legal filings that would concern you with regard to any of the individual investors, and those are always very important to do. Transparency, and this in fees, that's really almost a difficult challenge these days, and part of the reason for that is even in my own experience, there is a fee on a percentage of assets that we charge our clients. Well, where does it go? There is a block number, but I only get a piece of that. There are fees that go to the firm. There are fees that go to the mutual fund companies that we hire, or in some cases, the funds that are managing buys and sells of security for clients. And so, in truth, there is a question of if you're building a platform of accountability, who gets what, and for what is that service. So having the ability to identify specifically what that proportion of fees to those various specific different players is out of the total that you pay almost gives you a better shot at being able to evaluate where's the value. As an example, one of the things that we do for our clients is we show how much they are paying specific fund managers in terms of the expense ratios, or managed account players, how much they're getting paid, and we quarterly compare that after-tax fee to a benchmark return so that the client knows, are they generating alpha? In fact, are they generating returns that equal or exceed what we would pay a passive index fund to be getting? It's a reasonable thing to look at, but it enhances the complexity of being able to take a look at fees for the specific client. Another question is, are you open architecture? If you look at the research on which the recommendations to you are built, are there firm profit products in that research, or are there not? In other words, the value of that is, are you getting independent advice with regard to the recommendations and the research that's being done on your behalf? And is the fundamental input for the valuation of which fees to recommend and so forth? Another big issue these days is risk tolerance. This is a touchy-feely kind of thing, and Peter was talking about it a little bit. Propensity for risk versus willingness to accept volatility in terms of how you judge that. This is really there are now software tools that are available to help make that distinction. There is a firm called AAII that does have an online platform that allows people to take risk, and those go to the firm to design one of 5 portfolios depending on your risk profile. But I believe that the industry has got to get much better at doing that on a more holistic basis. And full disclosure, I work with a company that is working to develop a risk profiling tool based on the big 5-factor personality traits called Market Psych Insights that we think has a much better, more valid approach to that, and it's intended to help advisors do a better job of evaluating their client profiles. Passive and active index solutions, that's obviously a question to ask, and a lot of questions you guys posed to Peter were, I think, right on point in terms of coming up with the answers to that. Long-term career plans, succession plan for your business. Clearly one of the things that I suggest on the basis of the number of retirements that we're going to see coming would be something that is important to consider. The other thing I just mentioned, groups, categories, and potential clients, that can be a touchy question sometimes to ask, but it's one that I think needs to have some time given to it. And the other, conflict of interest situations, and I mentioned disclosures being an important part of that, but the management of it is really an entirely different question. So, questions? I finished up a little early, but yes, sir.
You know, there's a gentleman who comes on CNBC all the time, advertising for, I guess he's the owner of the company, I don't remember his name. But he says we're fiduciaries and we have to do what's best for you, sort of implying that CFPs don't do what's best for you. But in your talk today, you seem to do all those things. So what is the difference between what that firm does and what we do?
Well, I'm not sure what the firm would be, but if...
Well, a question
Fisher.
Oh.
I didn't want to mention his name, but he says...
It's not like he's holding his name back. It's Ken Fisher.
Yeah.
No, I don't think it's...
I'm not sure if you ask him specifically if he was a fiduciary, he would answer the question. And the major firms have been a little cautious to change their description from a suitability standard to a fiduciary standard because clearly the fiduciary standard is higher. But in my opinion, if you're asking anybody for the services that they provide you, it's a legitimate question to say, are you acting as a fiduciary in terms of the recommendations you're making to me, or are you recommending suitable investments? Because that distinction tells you. If they say recommendations are suitable to you, it's not the fiduciary standard that they would be held legally to if they identified that. Yes, ma'am.
Personally, I don't want a fiduciary.
Why?
Well, because in that whole thing, what's best for you?
Yes.
Well, it assumes they have some crystal ball that they're going to plug into and spit out according to their algorithms and my age and what they think, what's best for me. Personally, I don't think they have that. And I think a much more valuable discussion can happen other places than their view of what's best.
Part of the issue in that, and I agree with what you're saying, but in my opinion, there are situations in which an advisor will really focus on the dynamics of the family and the individual client. And another example, when you go to a doctor or a psychologist or somebody, an attorney, another professional who is focused on solving specific issues that you have. I need a trust. I need an estate plan that's going to transfer these assets generationally to family. one of the things that some investment advisors do they'll have those discussions in advance with their clients. They'll identify all the assets they'll tee up the process for an attorney, and in my experience, doing that and preparing the client to have their visit with the estate plan attorney can save them fees. So who do you trust to have that conversation with to ultimately have the right outcome? That's the kind of things that, in my opinion, fiduciary focuses on. In other words, how can I be effective and add value in ways that identify all the components of framing the right actions for you to take on your behalf, and collaborating with the other resources to get that done, whether it's investment, attorneys, insurance salesmen, and so forth. That would be my answer to that. Yes, sir.
Where are we? A year ago, fiduciary standard was going to become the industry standard. And then when Trump was elected president, he put people into powerful positions and they tried to pull that back. What is the status of all that today?
My understanding is that, at least from the CFA Institute standpoint, we are pushing for that to flow through and have the fiduciary standard applied to anyone who refers to themselves as an advisor. Whether the SEC and the regulators in Washington actually do that or not is another question, but our position is, let's do it. Why not?
Big companies,
Yes.
Merrill Lynch's of the world, against it?
Yes.
They feel it's going to cost them money.
They're saying, give us some time with that. We still have, and in my firm as an example, and a lot of the major wirehouses, it's that way. There are a lot of the traditional brokerage guys whose business is simply trading stocks for clients, recommending stocks for clients, and not doing the other issues that would need to have that be the place. The CFA Institute would say, call them salesmen, because that's what they are. That's what they do. Don't call them advisors. And the firms are saying, well, we've been calling them advisors for so long, now it's going to be difficult for us to switch. And if any of the clients that have gotten used to calling them advisors feel like that they get, that they're not observing their best interests for some fashion, they would have an actionable way to challenge the firm. So the firms are saying, we're not ready to do that yet. And so it's a back and forth push.
We're in a gray area right now.
I would say we're kind of in a gray area. How that gets done remains to be seen. But people who are looking and doing those deep dive questions with people that they're thinking about hiring should be able to discern whether they're being served via a suitability or a fiduciary standard, so you're equipped to make a prudent decision about who it is that you choose to hire. Yes, sir?
Yeah, I'd like to make a bit of a comment here, tying in together something that Peter said and what you said, that Peter said the best plan is the one that you'll stick with. And I think one of your points there about what a good advisor will do will be to prepare a policy statement for you.
Yes.
And I think that a really good advisor will prepare something, explain it to you, so you can stick to your plan. And that's a value that you would bring to the table that they wouldn't have with just going online and using a robo-advisor who says, answer these 5 questions.
There was an interesting ethical study by the CFA Institute. I agree with you precisely. And for all clients, an advisor, I think, and the CFA Institute and the code and standards require it, you need to have an investment policy that outlines what you're doing for the client, why you're doing it, how you're holding yourself accountable for performance under the work that you're doing for that client. And that should be clearly part of every engaged policy. There was another point I want to make. My mind went away, though. But I agree with you. Everybody ought to have an investment policy. Ought to be what is required. Any other questions? Yes, ma'am.
If you go to somebody there, a fiduciary, and you want to do something that they need not, do they not do it? Or can they take a portion and do what you want?
I think if you're a fiduciary, it's an all or nothing kind of stand. And I know what I was going to mention. There was an interesting ethical study that the CFA Institute does case studies on whether the right decisions were made or not. And in this particular example, an advisor had a client come to him with a newly floated stock offering and says, I think this is really going to be a major upside. I want to buy $1 million of this stock, some large proportion. The advisor said, I appreciate your perspective. I want to make it happen, but I think that's way too much money. Given your pool, this amount of money is too much to invest on a single stock offering, and I advise you against doing that. Well, the guy said, just execute, and it is what it is. So the advisor says, okay. Executed the transaction. The stock fell in the tank. He lost a big chunk of the money. And he went back and he sued the advisor. He said, you didn't prevent me from, you didn't talk me out of, you didn't successfully talk me out of doing this. And so the interesting thing on the call was, the point that stuck in my mind was this when we were doing the case study, one of my colleagues says, wait a minute, are we supposed to protect clients from themselves?
That's why I don't like it.
and well, the answer,
Don't smack and let Darwin take over and everybody.
well, my response to that was, if you have clients that you care about, you do the best you can to avoid having them make mistakes, and you try take a real hard line at trying to do that. And it wouldn't be appropriate for the guy to say, I'm not doing that, but it could have taken additional measures to try and talk his client out of it. Yes, sir.
Couldn't the advisor have the client sign this
Yes.
conversation we had? You're doing this.
Yes.
And he would do that.
Legally, that is ultimately what came out of the case study, to say, if you feel so strongly about your client not taking an action, then you do have to protect yourself legally, and that would be a way to do that. Certainly have him sign an understanding that you objected to it, you told him you objected to it, and he did it anyway, and you're following his direction, which means that you're not held responsible for it. Yes, ma'am.
Okay, this morning, Peter emphasized keeping fees low, because obviously that's less money for the investor. But I remember years ago, I took this introduction to investing class at this community college adult education. And I remember the last session, the guy who taught it said, if whoever you're paying to handle your money, if they're making money for you, they deserve something for it. I want your take because he said, I have a hard time impressing on people that if they're actually making you money, they deserve some kind of compensation for it. And you didn't mention that at all. You didn't mention how about monetary compensation for the financial investor.
It's a fair question, and I would say it's a touchy-feely area, because when you are counseling your client on the right actions to take, and you're doing investment decisions that have long-range implications, and you're assessing who they are and what their wealth is and what it means, and helping them translate that into an action plan, that's not easily quantifiable. I mean, how much do you place on the emotional value of good advice and prudent advice for clients that helps them plan for a long term and has the growth that they need, that their family's going to need, and that kind of stuff? It's not an easy thing to value. I think the best way to do that, in my opinion, is to look at the industry stats for percentage of assets billing and the services that go with those various levels of service, and say, are we reasonably prudent in terms of how we stack up relative to a comparison with the others in the field? They're doing the same things. And
every year at income tax time, I'm aware, darn, I'm spending all this money somebody to help monitor my money because I don't always have time to do it and things like that. And that's what's always impressed upon me. And a lot of the other stuff that you mentioned, it's not always impressive.
Well, one of the things that I think is important for advisors that are holistic in their approach to their clients to do is to collaborate with the client's tax preparer, tax specialist, and identify where we are in the year, what's happened, and if there are strategies that should be taken prior to the end of the year that would add value by reducing capital gains and losses, for example, or if there are contributions to charities, or if there are distributions from qualified retirement plans that can be directed to charitable contributions for a client. All of those planning ideas, I think, are part of the household alpha that goes at what are you paying for. And if you have an advisor that you're paying some fees to that does that active collaboration and puts in place an active dialogue with CPAs that are doing tax work, I think you're getting some value. As a non-practicing CPA, historically, not a lot of CPAs are real proactive in reaching out to the investment guys prior to the end of the year. Some are, but the firms, it's not a normal practice. They're more retroactive. After the year ends, then they'll say, give me my stuff, I'll do your tax work. So to me, that needs to be a proactive, value-added idea. This is the last slide, but it does have some resources that are, I think, interesting to read. There is a good one too. The Geometry of Wealth is a new book that Brian Portnoy of Chicago just put out that has a lot of interesting observations with how to integrate values in the management of your wealth also. Dan O'Reilly always does good work in terms of behavioral finance, and that's really good. In terms of trust, too, this top resource is really an excellent one that I have used, Solomon and Fernando Flores, in terms of how you evaluate trust, what factors go into it, and so forth. So that's some good potential resources for you.
One more question? One last question?
Anyone?
Okay. All righty.
Thank you.
Thank you very much.
Pleasure.